part of my mission is to educate people and help people make the most informed decisions possible. And if I can't help, I can probably point somebody in the right direction. So let's get started. This is kind of the plan. Tax filing, the actual tax return, is the culmination of a lot of decisions throughout the year. I wanted to get started with kind of how the pay stub, what the pay stub is, what it looks like, because many people don't have a clue what it says. There's a lot of useful information there. The other thing that goes into the, what kind of fills the pay stub is the W-4. So we'll look at the form, we'll kind of see how it works. We'll talk about the tax system a little bit, brackets, deductions, all in the context of the pay stub. And then we'll devote a little time to the 401k. I am not a financial advisor. I know enough to be dangerous. And this is one of the gifts the Congress and the IRS gives us to save tax and save a little bit for our future. We'll talk a little bit about the US tax system and its history. And then at that point, we'll kind of flip the switch, right? A lot of W-2 employees, it's very basic, 1040, a couple of schedules. And then if you happen to have a side gig or you have a little, you are a full-time contractor, I want to give a little time to that and then talk about, tax deferral accounts for self-employed people. And then we'll just, we'll review the 1040 and the Schedule C, which are the two big components of this presentation. Okay, so what happens when you guys, when you get your first job, right? Any job you go to will have a ton of forms for you to fill out, right? There are citizen verification forms or, eligibility to work in the US. There's the W-4, which kind of gives the payroll department your tax picture, direct deposit forms. There'll be benefit forms at some point. All these things kind of play a part in your pay stub. Okay, so a lot of paperwork, ask a lot of questions. Your HR department is there to help you. Don't be shy. You will not regret it. So the first thing I want to do is review the W-4. So this is the W-4, right? When you first get hired to a job, they will give you this, personal information, demographics, social security. So your social security number is the key to everything, right? People like me that have clients that, may not really care about giving me all the paperwork that exists tied to their social. I fill out a POA with the IRS, and because the social drives everything, I can pull everything that's tied to their social that the IRS has. So that enables me to have a complete tax return. So this is really important. But then one of the most important parts is this, right? C. And this is whether you're single or married filing separately, because you will be taxed at a different rate. Married filing jointly or qualifying surviving spouse, different rate, and head of household. It can be as easy as doing that and then signing, right? If you have multiple jobs, if you have a lot of dependents, that's where you have to fill in the meat, okay? And this is where it gets hairy, because if you have a job and your spouse has a job, it is very likely that you will be over withheld or under withheld. And, part of the whole thing we try to do at the firm is avoid surprises, right? Make sure that, you kind of have a good idea of where you are. And this is why the pay stub is important, okay? So a little bit about pay stubs, okay? This is what a pay stub looks like, right? You will have your name, pay period information, pay period beginning, period ending, pay date, hours worked, benefits available, benefits used, taxes, deductions, pay, summary, and then net pay, okay? This is all very important. So let's talk a little bit about pay periods, right? A lot of jobs are weekly. That means you will get paid every Friday, and that's 40 hours standard, paid weekly. Then you have biweekly, which is basically 2 weeks, 80 hours, paid every other Friday usually, and that's 26 times a year. And then semi-monthly is twice a month, and that's 86.66 hours, and that's paid 24 times a year. Usually, hourly employees will be weekly or bi-weekly, because the semi-monthly, the pay periods fall at awkward places. So a lot of places will actually have two different payroll runs. One for, hourly folk, which will fall into one of these, and then the salaried, which will fall here. Deductions, right? Payroll deductions are going to be a key part of this whole pay stub and your ultimate tax picture, right? You'll probably have access to benefits, and that's, you have medical, dental, vision. Sometimes you'll have voluntary short-term disability, voluntary long-term disability. You'll be able to make charitable contributions, all sorts of things, obviously depending on the size of your employer, right? A lot of these are pre-tax. What this means is, let's just say your gross pay is $100, but you have a $5 deduction. That means you will only be taxed on $95 instead of the full 100. So it's a little built-in tax break. Retirement plan, that's typically your 401k with an employer, and you can do pre-tax, post-tax, and this is one of the easiest, lowest hanging fruits, best benefits ever. I love 401ks. Okay, any questions so far?
My name is Matthew Wundo. If you have filled up the W-4 before and you want to get it updated, how can you do that? How can you go about that?
You should ask your HR or payroll department what the process is. I can tell you for us at my firm, the employee will just come and say, hey, I need to update my W-4. And we give them the copy, they fill it out, and then they turn it into HR. So it should be that simple. Okay, all right. I apologize if y'all hear my ferocious beast of a dog. He barks at everything.
Hey, Victor, I have a question. Can you repeat again what you said about the benefit, the medical benefits, how the pre-tax kind of thing, how it's yeah, please. Thank you.
So I'll explain it here in the context of the pay stub, because I think I'm a visual person and I think that'll help. But when you get benefits, when you get hired, right, you will get paid, right? Regular pay, 5 hours at a rate of $125, boom, year to date, right? So this person's gross pay is 125, 250, 500, 625, but there's this pre-tax medical here, right? This 6250. So you would subtract that 6250 from 625, and I don't know what you get. I need Excel to do math. But basically the whole point is that you're only taxed on the low number. That's what you pay federal income tax on, the low number. You will still pay Social Security and Medicare tax on the full amount, but you'll only be taxed for income tax at the lower number. Does that kind of clear it up?
Yeah. Thank you so much.
Okay, perfect. Okay, so let's look at the pay stub again, right? 625, and then you have your taxes, right? And remember the W-4, single, married, all that stuff. Depending on what you put will determine this federal income tax. No, the federal income tax rate you're taxed at and what you're withheld at. Right? Ultimately, since you are paid regularly, you are withheld, as frequently as you get your check. Your company forwards that money to the IRS. And then when it's time to do taxes, you basically take your W-2, you put that information in, and you get that credit for what has been withheld. Ideally, and this is my preference, personally and for my clients, you owe a little bit, right? A little bit, less than $1,000, cool. Because if you overpay, you're basically giving the government an interest-free loan, and sign me up for that deal any day of the week. So then let's move on to the Social Security and Medicare, right? When you're a W-2 employee, so Social Security and Medicare end up being around 15% combined between you and the employer, right? When you're a W-2 employee, you are paying half of that. You pay 6.2% for Social Security, and then you pay 1.45 for Medicare. Social Security has a max out, right? If you happen to make more than $147,000 in a year, that was the max out for 2022. Because of inflation, the max out for 2023 equals $160,200. That's not in tax, that's in wages. Okay. So once you max that out, you no longer pay Social Security, and it kind of caps out. Medicare goes on for all eternity. So you will pay Medicare forever, but that's okay. We should pay a little tax, not a lot. And then the last tax here is state income tax, right? This person here, Oliver Foster, is from Boise, Idaho. So as a result of that, he pays Idaho income tax. And state income tax, depending on where you live, right? It can be anywhere from 5% to 13.3%. Texas does not have an income tax. We pay many other taxes, property tax, franchise tax, all sorts of fun things but we do not have a sales tax, but we do not have a state income tax per se. Okay, any questions on this pay stub, kind of, the taxes down here, the deductions, the summary, the net pay? Any questions on this?
I was asking, trying to understand when you did mention something about if you have an income level of about 140 as of last year or so, is that for a job, somebody that have two jobs and the amount more than that or about that, is it that percentage, is it based on that combination or just per job?
So each company will have their own records, right? When you go and do your tax return, if on one you had $100,000 and on the other one you had $55,000, you probably overpaid Social Security by a little bit, right? So they will give you a credit there as your overall tax. Okay. You don't lose it.
And that credit would come through the federal filing or how?
Yes. Yeah. You need to file your federal 1040. That's kind of what reconciles everything.
On the same question, like if you have a W-9 and if you have two jobs, so do you put deductible, like you have the deductibles and all that, do you put some number or you just put 0?
So W-9 is different.
I mean, is it W-4 or W-9 form? Like where you put the deductible? Yeah.
So a little bit later in the presentation, we're going to talk about contractors, and those are the ones that do a W-9. They play by a couple different rules.
Okay.
So is it a W-4 question or W-9?
I mean, anyway, where like you put a deductible, right? Like you want to cut a certain amount of your taxes or withdrawal, right? Whether you want to play deductibles or not, is it good option to put a number there or just put 0? Like,
Look, there are people that at the end of the day, there's a little of a personal preference to this, right? There are people that don't want, they fear for their life for owing any tax. So I suggest you are as conservative as possible and put 0, right? So you're taxed at the highest level. Now, some people that are, they may be single and they may be making good money. They probably need to have more withheld than they would normally. So you can add a number there of additional dollars to be withheld. As for the W-9, that means you are a contractor. If you're a contractor, you are responsible for your own taxes. Nobody forwards them to the government on your behalf. You have to do it yourself. And we'll talk about that in a little while.
If you're filling the W-4 and you have dependents, if you add them on that form, like the number of dependents, or you don't add, what is the impact? That's on both sides. What would be the impact?
If you add them and
if you don't add them?
So if you don't add,
Yeah.
you will probably overpay your taxes. Probably. Okay, probably. Big disclaimer. If you do add them, the idea is that you get closer to the actual number, right? But payroll systems sometimes use different calculations for taxes, unfortunately. So there's no one blanket answer. What I suggest you do is you look at what happened last year, right? On your tax return, and then look at what's happening this year and look at your year-to-date withholdings, right? And if you're a month in to the year, you should have paid a 1/12 of that number that you actually owed. And you can kind of tweak that way. Like that's the whole point of the pay stub, to give you information to be able to take action or to not, right? At the end of the day, you're gonna be like, no, I'm good. I'll just pay it on April 15th. And that's fine, but sometimes it gets overwhelming. Okay, the 401k can be the largest deduction, right? Every year it's indexed for inflation. And I believe this year it's $22,500. So what that means is, just like your medical insurance, if it's part of a Section 125 plan, you are able to take that off of your salary, basically off of your wages, right? So you do not pay income tax on that number. You will still pay it on Medicare and Social Security, but you don't pay it on the wages. So for example, if you're making $100,000, you subtract 22,500 from that. So you're only paying taxes on the balance, which is 78.5, I think. I don't know. Let's make sure I'm right. 77.5. So instead of paying taxes on the full 100,000, you're paying taxes on the 77.5. Okay. And so I don't know what everybody's familiarity is with the 401k and kind of how it does. I am not intending to make this a presentation about financial planning, but part of my job is to try to optimize people's tax situation. And one of the easiest deductions, if they elect to do pre-tax, is a 401k. So a 401k is a retirement savings plan that lets you invest a portion of each paycheck before taxes are deducted. Note that there is a Roth available, which means instead of taking it pre-tax, you take it post-tax. That also has its benefits, right? Like in both of these accounts, in the regular 401k and the Roth, you're basically putting money away in an account, right? That's invested in the market. And then you will not, on the regular it'll grow tax-free until you need it, right? Ultimately, and that's one of the caveats, right? Like you can withdraw it whenever you want, but if you're doing a regular 401k, you will pay the income tax that you did not pay originally, and also 10% penalty for an early withdrawal. Okay, like this is such a good part of the IRS code that the federal government will impose restrictions so that you don't get the benefit and also get to use it. Right now, a lot of 401ks have loans inside of them that you can use instead of taking a distribution, is what it's called. Now, there are also special qualified distributions. I think one of them's a first home. During COVID, there was the ability to withdraw, I don't even remember how much from it, and not have to pay it back, kind of a form of a loan. So, it can be very powerful, but it's not like, free money, right? Like it has its strings, which is fine, right? I mean, at the end of the day, anything that helps you save for the future, whether it makes more sense for you to be taxed on it now or later, is probably good for all of us in this country. So let's talk about a little bit how it's taxed. When you reach, I believe I don't know if it's 62 or 59.5, you're able to take distributions and you're not subject to the 10% penalty. Now, you are not forced to take them until, I believe it's 72. Every year, these numbers change depending on the life expectancy of us humans, and sometimes who controls Congress. So if you let it sit until the later part of your life, your money will grow more. If if you're fortunate enough to have retired at 59 and a half, or you actually need it, then you can still withdraw it. But obviously you miss out on the growth in the future. If you're doing a Roth, you will not pay taxes on anything, right? You do not pay taxes when you withdraw it. You do not pay taxes on the original deduction. You do not pay taxes on the income from that deduction. That's the good thing of the Roth. Financial advisors like to push a lot having different buckets. And if it makes sense for you to not take the deduction now and let the money grow tax-free, great, do it. If it makes sense for you to take the deduction now, because having lower taxes to pay now is more valuable than whatever uncertainty the future holds, then do the regular 401k. Now, there's also one thing we haven't talked about, and that is the employer match. Most employers want to incentivize their workforce to contribute to 401ks, so they will do a match. Sometimes it's, I've seen anywhere from 1% to 6%, and it's dollar for dollar on your salary, 50 cents for every dollar, up to 6%, up to 3%, all sorts of varieties. If you are able, and it doesn't matter if you do Roth or regular, if you are able to, I strongly suggest that you contribute at least enough to get the match, right? Because if you put in, let's just say $6,000, and they match dollar for dollar up to 6% of your salary, and your salary happens to be $100,000, you literally doubled your money. I know life gets in the way a lot of these things, but that is literally free money. If there is any way for you to take advantage of it without going into debt or anything else, I mean, it's worth doing something at the very least. Okay, this is my favorite slide. We're going to talk a little bit about the US tax system. Okay, so this is a nice little meme that's been going around. So Jamie, you want to play the government for me?
I would love to.
Please.
Okay.
Let's do it.
You owe us money. It's called taxes.
How much do I owe?
You have to figure that out.
I just pay what I want?
No, we know exactly how much you owe, but you have to guess that number too.
What if I get it wrong?
You go to prison.
Not funny. Not funny.
Sorry, it's
That's a nice role from you, Jamie. That's cool.
Thank you.
So this isn't exactly that drastic, but it's the tax system is kind of interesting, right? Because if you're a straight W-2, if you do not need to declare any other deductions, like through a business, as a contractor, or anything like that, your taxes can be pretty straightforward. There is a scenario where everything is on your social and it can be computed very easily. In fact, when you don't file tax returns, the IRS will do that for you at the least favorable rate for you. If you are married, they will do it as single. So the IRS does do that when you're like literally about to go to prison. They will do that when they're about to levy your accounts. So with that said, I want to talk about a little bit of the history of taxes. I studied a lot of history. I know this is kind of unrelated, but I think it's really interesting. So if you guys would just bear with me for a little bit, it's a little background. So when the US was first formed, there was no tax. There was no federal government, so there was no tax. One of the reasons the US probably came to be was because they revolted against the British for taxation without representation. I don't know if, well, none of us were around in the Boston Tea Party, but that was one of the big teas that really annoyed people. You know, they could levy a tax on tea, which everybody drank back then. And, you know, the colonies didn't like it. And they basically dumped 342 chests of tea. Here's a wonderful picture. Chests of tea in the Boston Harbor. Two of those people that were part of this revolt were John Hancock and Sam Adams. So, you know, for whatever it's worth, you just have to be on the right side of history, I guess, when you do something illegal. I don't know. Okay, so the first IRS, it was created during the Civil War to help finance the war. The first income tax came around to be in 1913 to help finance World War I. Back then, everybody paid the same, regardless if you were married, if you had kids, if you had whatever. It was a flat percentage, 5%, 10%, 25%, 22%, whatever. So it was a little bit more unfair. Today, we at least have what's called a progressive tax system, and depending on where you fall is what you pay. Okay, so I'm going to show y'all a history of the highest marginal income tax rates. The marginal income tax rate refers to the highest bracket you touch. That doesn't mean every dollar, let's take 2022. That doesn't mean every dollar you earn is taxed at 37%. It means if you fall into the highest marginal tax bracket, you will pay 37% of that dollar. And I can tell you, in 37% for married people was $647,851. So if you made $647,850, not a single of your dollars was taxed at the 37% rate. If you made $647,852, one of those dollars you would pay 37 cents on the dollar. Now, I personally think I would rather keep the inverse of 63% of something than not keep it. Okay, that's the not have it. To me, that makes sense. So there's an incentive to still keep on earning money. But okay, as you can see here, you know, we start at 7 in 1913. Then we somehow go up to 77 in 1918. Then we kind of trend down again, trend down, trend down, trend down. Then we start getting into world wars. 94% marginal tax bracket. I don't know what the number was, but that's a big number. You know, then they kind of come back down, then they go back up, come back down a little bit. And all these fluctuations also have to do, fortunately or unfortunately, with Congress and whoever's in power. So it's really interesting to see. I mean, you can kind of see the trend, right? You can see, oh, this was Obama. Oh, this was also Obama. Oh, this was Bush. Oh, this was Clinton. Oh, Bush Senior. So it's really interesting. You know, if y'all want to nerd out, feel free to stare at it like I do. Any questions so far?
Sorry, I might have missed what you said, but the top margin rates are like the highest
Yes.
rate for the highest possible
for
income.
$1. Yes. So like, let's take, are you married?
No, I'm not.
Okay. So let's use this example on the slide. That's the reason I ask. Because we're going to assume you make $539,900, $539,900, okay? $1 less than this. That means none of your dollars will be taxed at 37%. You'll be subject to all of these other ones, right? The 35, the 32, the 24, to come up to your effective tax rate, which is a blended tax rate of all of these numbers. but none of your, you will not have a single dollar taxed at 37. If you make this number 539,901, that $1 will be taxed at 37%. Does that make sense?
Yep,
Say it
it-
one more time, Victor.
Okay. So if we make $539,900, not a single of our hard-earned dollars will be taxed at 37%. They will all be blended here. Okay, on the 10, 12, 22, 24, 32. So it becomes what is an average tax rate between all of these numbers. The $1 that you do make that's over 539,900 will be taxed at 37%. And every dollar above that is taxed at 37% as well. Better? Yes?
So the 539,900, I will be taxed at 35%. And then the $2 that I made extra, it will, just the $2 will be taxed at 37%.
Kind of correct. That second part you said is correct. You are only taxed at 35 at this interval.
Okay.
Then at 32 at this one, then at 24. Yeah, this is fun. This is fun.
So how many times I will be taxed based on this graph?
You'll tax on it. You're taxed on every dollar you're earned. Right.
Okay,
like,
but in each bucket I have to tax and then I will jump to the other bucket?
yes, basically, yeah. You pay 10% of this.
The first
12%.
10,000.
Yes, 12% of this, 22% of this, 24% of this. Now, this is just your basic tax calculation, not considering deductions, credits, or anything like that.
And this is, if you have two jobs, this is per that payroll or your total at the end of filing.
Total AGI. Now, there are different things that are taxed at different rates, right? We have capital gains, we have dividends, we have, pass through, but in general, this is a good barometer. So I'm not sure, let me check. So this was 2022. So 2023, they're obviously indexed for inflation. Yeah, but they don't give me they haven't given me oh, here they are. So the 37% for 2023 is $578. So about almost 40K more. Almost. And that's the other thing, right? All these numbers are indexed for inflation most of the times, right? Like there are certain of the deductions that they didn't index for inflation, which is kind of brain dead, but I didn't come up with a system. Our wonderful Congress folk did. So this is kind of the final closing point for, at least for now, for W-2 and kind of tax brackets. Contractors. So there's a couple of things that I want to mention. Like I said, your advisor should not only, put on his blinders and think that tax is the only consideration. It's one of the many considerations, right? Like you want to make sure you are doing things that you want to do, right? Sometimes that tax deduction, well, it's not really a tax deduction and you should not take it. But so let's talk about contractors. One of the big things that we like to look at is risk, right? What does that mean? If you're a consultant and you mess up and you get sued, that there is risk in that. There is risk that somebody doesn't like the service you provide. You mess up. We're all humans. We all mess up. So there are some things that people should do to mitigate that risk, right? One of those things is, create an LLC, right, with the state of Texas. That will separate, your individual from your business. And if you do things right, like set up different bank accounts, like actually run it like a business so that corporate veil is intact, you can, you can mess up and you can somehow insulate your liability, your risk. The other thing that I advise a lot of clients to do, and there is nothing in it for me if I advise them to get an umbrella policy from their insurance provider. It just adds another layer of complication to people that want to get through so that your personal assets are protected. Not a lawyer, big disclaimer, I'm not an attorney. So, obviously if this is something you want to pursue, talk with a lawyer. The next point that's key for contractors is have a separate bank account and credit card. If you do not want to invest in a software like QuickBooks or Xero because you don't have that much work, you don't want to use it, fine, whatever. I would strongly suggest you do it. I mean, it's $50 a month on a good day, and that gives you information, at your fingertips, and information is power. But in the case that you do not want to do that, you have a separate bank account, you have a separate credit card where all your business expenses are run through there. So you can come back and, do a little spreadsheet. Most banks allow you to download all your activity in a spreadsheet. And what you do then is you classify things according to what they were. So you know how much you spent for, meals, for insurance, for wages, for whatever business expense account. You can create a little line item, and then you do a little pivot table, and it'll give you the information you need. And same with your credit cards. But intermingling personal and business, you should not do that. You shouldn't ever open yourself for more questions than are necessary in the event of an audit. So I mentioned QuickBooks and Xero. This is part of record keeping, right? Good records are necessary not just for tax preparation, but for you as a business owner to know where your money is going. Just as important of knowing where you end up is knowing where you are at a given point in time. Because if, come April 15th, you're just, oh, here you go, here's my tax information. But you realize you spent $20,000 on marketing and you only wanted to spend $5,000, well, it's too late to make any changes. But if you're keeping your records throughout the year, monthly, at the very least quarterly, you will know that you're probably being charged by some marketing company $1,500 a month, and you wait, what is this? And take some action before it's too late. So record keeping is good for that, to provide the business owner information, and then obviously for taxes, right? And a lot of QuickBooks Online, Xero, your bank accounts will sync with them. So it's really easy to classify and put things where they belong. I mean, QuickBooks is really trying to drive us, independent CPAs and accountants out of business, but they have a good product, and if it results in a better outcome for people, then great. The next item that I think is key to having a successful business, side business, whatever you want to call it, is hire professionals. Yes, it is going to cost you money. Yes. But if you go and open your LLC and it's all broken, LegalZoom will charge you $700. An attorney, $1,500 probably, $2,500 for a simple LLC, but it will be done right. The other reason you need an attorney is if you are ever sued by that customer that didn't like the service you provided, it's probably good to have an attorney that you know and trust. So, it may cost you a little bit more in the short run, but in the long run, it'll be worth it. Then if your business grows to the point where you need to scale, you need employment contracts, you need contracts with vendors, you need contracts with your partners, you need all sorts of fun things that attorneys can help you with. And, ultimately, when it comes time to sell your business, the attorney can help you navigate that sale. An accountant, my favorite. Not only do you need to stay compliant with the tax authorities, that is, unfortunately, that's kind of what we're relied on to do. but we can add the right accountant can add so much more value to your business by giving you information that you wouldn't have otherwise. Like these two things from above, the separate bank accounts and record keeping, your accountant can do that for you. And you find one that you're comfortable with in their abilities, that doesn't charge an arm and a leg. And, you know, you can have quarterly financials, monthly financials. They can make sure you stay compliant, sales tax reporting, quarterly reporting, year-end reporting. They can take care of everything so that you can do what you have to do to grow your business, right? At the end of the day, nobody goes, well, unless you're Garza Gump Group, you don't go into business to be an accountant. You go into business to, you know, sell whatever you make, sell your service, deliver your service, whatever it is, but your time is better spent growing your business. So surround yourself with people that can help you achieve that goal. The last, well, it's kind of the last one, but not really. Hire a financial advisor, right? Like as your business grows in prosperity, there are, you know, just like you have a 401k when you're a W-4, W-2 employee, when you're a contractor, you also have access to other deferral accounts, and a financial advisor can help you navigate it. The financial advisor can also help you come up with a strategy or plan so that you can retire if that is what you want. If you want to go buy a boat, then they can also help you come up with that strategy, or put your kids through college or whatever it is. They can help you come up with a plan to meet those goals. You know, and as you grow and become more prosperous, you know, you will hire a marketing group, you know, your insurance people, you'll have employees eventually, you know, your recruiting department, your accounting department, all these, like, you should, if your business allows you to and the need is there, you should not be shy about hiring people that are smarter than you in their field. 100%, it's an investment. The other thing that's big with contractors, similar to a 401k, are all their deferral accounts for self-employed. I like these because they are tax deductions if you do the pre-tax ones. If you do the Roth, then it's part of the play to not pay taxes in the future, and that's fine, but we don't get a tax break now. Also, the Roth actually phases out if you're self-employed and at a certain income level. So unless you have access to Roth through a 401k, you can't do a straight up Roth. There are strategies to get your money into a Roth account, but first you have to make it, you know, you have to make a non-deductible contribution or a deductible contribution to the IRA. Then you do what's called the backdoor conversion. You guys may have heard about those. They were kind of a hot topic maybe a year ago when Peter Thiel, I think, and his PayPal stock, I mean, he basically had billions of dollars in his Roth IRA, and the IRS said that wasn't the intent of this, but he played by the rules, so it is what it is, I guess. So, okay, you have the regular Roth IRA and an IRA. These are limited to yearly amounts, and just like the 401k, a regular IRA will be taxed upon distribution. The Roth will not. You have a simple IRA, which is kind of like a junior 401k for companies. This has a limit of, I think, of about 16.5 for 2023. And, you know, when the 401k limit is 22.5, but if you're an employer, having a 401k costs you money. There's a Department of Labor regulations, record keeping, yearly filings, fiduciary stuff. So it's kind of a whip. So if you're an employer and you're like, you know, I have 3 employees, I don't want to do a 401k. A simple IRA may fix it, what you want to do. And then the SEP has higher limits than the prior options, and that's pre-tax, but you can stash away, you know, up to $58K a year, which is very good money. Any questions? This is kind of my And I personally would probably go to a financial advisor and coordinate with an accountant to make sure that, you know, your goals align. And usually advisors will invest these for you. I think we're all put on this beautiful earth and we all have some core competencies we're very good at. And, you know, granted, some people enjoy playing the market. That's great. That's fine. But you should have safe long-term money, and gambling is what I call it. And if you know, if you're fortunate enough to need an advisor, then definitely let them handle the long-term money, and you can short Tesla all you want, or Apple, or whatever makes you feel better. So that's basically it for the tax deferral accounts.
Just a quick question. What would you recommend? Roth, either a Roth IRA or IRA against the 401k? Which one would you recommend that we have?
So your 401k probably has a match. Okay, so I would do that. Your employer probably pays the cost of somebody telling you where to invest it. I would do that. Like this stuff is for, you know, if you max out your 401k, the 22.5, and you still want to contribute to a non-deductible IRA, then fine, do that. But I would, if you're on a W-2 and you have access to a 401k, I would do that.
Thanks.
And then it's a question of, do you want to, you know, as part of your plan, are you better off paying the tax now and doing it a Roth 401k? Or are you better off taking the tax deduction now and doing it a pre-tax 401k? Okay, so this is your beautiful 1040. You guys may recall in our first conversation, well, in our first segment about the W-4, right? Single, married, separately. The same statuses are here on the 1040. So the tax system, I think the tax system is a beautiful system where like boxes fit neatly into where like Tetris. So yes, I am a nerd about this and I kind of enjoy like the complexity of it. But everything's connected, right? So filing status, you know, demographic information, yada, yada, presidential election complaint. I probably do about 400 tax returns. Not a single one of my clients actually checks this. So for whatever it's worth, digital assets. This is cryptocurrency. This is big. The IRS really wants to, you know, catch people that are not reporting what they should on their gains, really. If you have a loss, they don't really care if you take it or not, but it's really the gains. And since, you know, the whole premise of crypto is, you know, a large part of it is for people to move money around in shady ways. You know, those exchanges, just like, you know, Fidelity will give you a 1099, those exchanges will probably be next to give you a 1099. But right now, for reporting purposes, you should report your gains and losses, regardless of the IRS knowing about them. Okay, your standard deduction, right? Sometimes somebody else can claim you as a dependent. Usually, you know, this happens when you have a young kid that also worked. They would mark that they can be claimed as another dependent somewhere else. You know, if you are older or if you are blind, you get a little extra money as your standard deduction. Okay, so think of all of these income forms as a funnel, right? Everything gets funneled through, right? This is your W-2 wages. This is if you're a household employee and you didn't get a W-2, tips not reported, Medicare waiver, not reported on W-2. A lot of these things are reported on your W-2. Employer provided adoption benefits, other income. This one is actually, this one is the fun one. The one that we will really talk about is Schedule 1. So all of these are components of one, right? 1A, 1B, 1C, 1C. So all of these are actually new. Usually it started with 1A, wages, boom, done. But then tax exempt interest, which is interest that you don't pay tax on, but you still report. Interest that you do report, like typical would be banks, right? They pay you a little interest. I mean, now it's going to be a little bit more interest. They would be here on 2B, and 2A would have treasuries if you invest in treasuries. Qualified dividends, ordinary dividends, these are from your, from your 1099 DIV from Fidelity or one of those. 4A, we talked a little about IRAs and 401ks. So this is where they would be. Okay, here, and then the distribution and the taxable amount may be different things depending on the type of account and what happened inside of the account. But it would go here, Social Security benefits. You would, depending on your income level, you may or may not be taxed on them. This is new. I haven't seen it. Capital gain or loss. This is if you sell stock, if you sell your house, it's a little bit more complicated, but if you sell stock, if you sell crypto, if you sell anything like that, this is where the final balance would go, right? Like you would do Schedule D. Other income from Schedule 1, line 10. This goes back to what we have been talking about as a contractor. Right. And as a contractor, this is what you would typically do. Okay. Now, this is for a sole proprietorship, as you can see here at the top, sole prop. But the fact, oh, sweet Jesus, sorry. The fact is you can elect for your entity to be taxed a different way. I am not going to go into that because then it's going to open up another 2 hours of fun stuff. And I don't think anybody really wants that. But this is your Schedule C, right? This is, if you have a 1099 for $50,000, I would probably do it here. Okay. And so you put in, so, okay, let's go from the top, right? It could be a different name. It could be an LLC. Like that's okay. You can be a single member LLC and still be on a Schedule C, right? And you wouldn't do it with a social. You would do it with an EIN that you got. You would put what you do, right? Consulting, whatever, marketing, insurance sales, the business name. If you have no separate business name, then you leave it blank. Your business address, if there's any, it may just be your house address. The question that the gentleman asked earlier, cash or accrual, the IRS does ask you how you report your accounting, right? And the threshold for you being obligated to be accrual is about $25 million. So the vast majority of businesses can be cash, and cash is much simpler. Cash is money in, money out, right? Unless there is some specific business reason you want to be accrual or you should be accrual, then you would be cash, period. This is new. Material participation. That means that if you did not materially participate in that business, and there are several thresholds for what defines that, your losses are limited. Your losses are limited. That was not a thing here. Like, I have seen a lot of people be audited because they create fake businesses just to have a loss here to offset their ordinary income from over here, right? Because if you have a negative $50,000 there and you have $100,000 here, well, guess what? You're only going to be taxed on $50,000. That's your taxable income. Risky. Probably, not like that meme where you'll go to jail because, for $50,000, the IRS isn't going to send anybody to jail, but just kidding. I don't know, maybe. It's not worth the risk at the end of the day. It's not worth the risk. So let me, okay. So, your gross sales are 1, And then you have cost of goods sold, which is if you manufacture something, that's usually your cost of goods sold. So you have those two. Let's just $50,000. And then we have $25,000. So our gross profit is $25,000. Okay. So now we will have some expenses: advertising, car and truck, commission and fees, other contract labor that you paid people for, which brings me to another point. There is this question here. Did you make any payments in 2022 that would require you to file forms 1099? If you are here doing this for yourself, somebody probably gave you a 1099. If you should have received a 1099, but you did not, you should still do your taxes here. Okay, that's a dangerous game. I mean, granted, the probability of an audit is relatively small, but it is there. And by law, you should report your income regardless of you getting the form or not. But this asks you if you filed 1099s on behalf of the people that you should have filed for. So, you know, you should do that, and you should do this, right? Because maybe you paid your marketing person $10,000. It's $10,000. Okay. So, you know, these are the expense line items. I don't want to go into each one of these. Is probably a class or a little lecture on its own. So we'll keep it simple, and we'll come to total expenses of $10,000, tentative profit or loss. And this tells you what to do. Like, oh, subtract 7 from 28. So I am at $15,000. Okay, I made some money, right? Cool. You know, then you can put in other things. This is new. I am so amazed they put this here. All investment is at risk. That means we get the, you know, if you do inventory, you know, other expenses that are not here. Okay, so now that we kind of did a Schedule C, you know, this $15,000 from here would come over here. Okay. No, I put in the wrong line. My bad. So there was a gentleman that asked earlier about AGI, your adjusted gross income, and that is the sum of these numbers here. Okay. So the AGI for this person is $115,000. Solid year. Okay. Now, standard deductions, right? The standard deductions were changed recently with the Tax Cuts and Jobs Act. I guess not recent anymore, but they made them a lot higher. So majority of the people do not itemize. That means, like, if you're married, you get a deduction of $25,900, right? So you subtract $29,500 from this, and you get your taxable income. Now, I am oversimplifying drastically, okay? Just to issue a point. So 89,100 is our taxable income, right? So the gentleman also asked about charitable contributions. Charitable contributions would go on Schedule A, okay? I didn't download Schedule A because it doesn't affect the majority of Americans, but that's where your charitable contributions go, along with your medical expenses, property taxes, mortgage interest. But the fact is, for those numbers to be larger overall than 25,900 is pretty, you know, it takes a lot. Let's just say that it takes a lot. But let's just say they do, right? Let's just say you're very generous, and you donate $100,000 to charity because you can. So now your taxable income is $15,000. So this person will probably not pay tax. You know, then the tax is what's calculated, which we are not going to calculate. Let's just say it's $2,000. Then you have your other credits and blah, blah, blah. So this may end up being $1,000 after credits because you may have a kid. And then you had W-2 income, right? So they probably withheld you $18,000. So you will get $17,000 back basically here. And then you would get your refund. So it's kind of a funnel. And, the fact is my profession exists because this isn't easy, right? Now, if your tax situation is not that complex, you have a W-2 from your spouse or whatever, you maybe have a little interest income. You don't need me. You don't need someone like me. You can do it yourself. The fact is it's, TurboTax, the IRS, they have this free file tool that, if you make under a certain number of dollars, you don't pay for the service, right? But the fact is that that's kind of the agreement that TurboTax and all these big companies, IRS. Here, let me share this with you guys. So, and they kind of hide it, but there's a free file, right? Like free online, free simple returns for free, start filing for free, IRS e-file for free, do your federal taxes for free. The gentleman that asked about AGI, this is a requirement for you to file for free, right? $73,000 or less in AGI. Now, obviously, for you to get to that number, it's going to be like, I don't know if I'm there, but you have all sorts of resources for free, right? If you qualify, then use it. If it makes you feel better to have some sort of professional do it, then find somebody. Find somebody, but it may not be as inexpensive as one would hope. Let's just say that. Okay, any questions?
How does some of the write-offs get the case where you have like the 1099?
Let me make sure I understand the question. Are you asking me like what's a write-off?
Yes, and how do you apply it? How does it work with the tax?
Since we have this tool here, so what we want to make sure, look, I would honestly ignore, these lists are good guidelines, right? What can be written off as a business expense? But the fact is, the IRS is your best source of information, right? And what may be a business deduction for one business may not be a deduction for yours or vice versa, right? So the standard is that it has to be necessary and ordinary for your business, right? Like if I have a manicure and pedicure shop, I need nail polish, acetone, all sorts of things that would be a business deduction because of the service I provide, compared to if I'm running an accounting firm, I don't need nail polish and, all those other fun things that happen at a nail salon, right? So it depends on the business. And, honestly, like I would err on the side of caution, right? And everybody on TikTok wants to be an expert on tax, Instagram, Twitter, and the fact is somebody that has $100 million in real estate may be taking other risks or using the tax code to their benefit, but they pay experts hundreds of thousands of dollars to find those loopholes. Unfortunately, that isn't available to everybody, right? And a tax deduction for them for $100,000 may be a rounding error at the end of the day. I know this sounds terrible, but that's what happens. So I would be wary of what people tell you. But you know, the IRS has a ton of resources, you know, if ultimately, if you need guidance, find an expert, get the help. Right, but you know, every single one of these has its own little publication. This is the key one, right? What can I deduct? To be deductible, a business expense must be both ordinary and necessary. An ordinary expense is one that is common and accepted in your industry. A necessary expense is one that is helpful and appropriate for your trade or business. An expense does not have to be indispensable to be considered necessary. That is the best definition that you can use and apply. Does that help a little bit?
Yeah, it does. Thank you.
Okay.
Could you explain a little bit what is pass-through?
So pass-throughs, so when you set up an LLC, you can elect for it to be taxed as a disregarded entity, which is that Schedule C, when only you own it, right? That's technically a pass-through. A partnership, which files its own tax return at 1065, and you need multiple members to that LLC, partners, so that you can be a partnership, and an S Corp is also a partnership. So what happens with these is that these entities in itself don't pay the tax. They pass it through to the owners. Right? That's effectively what a pass-through is. Those entities will spit out K1s, and those K1s have, well, you know what? I guess we should show y'all. So you see it has all these items that are current year income deductions and credits. So the ordinary income would be here, or loss, right? The loss is subject to certain constraints, right? You have to have at-risk capital or qualified or recourse financing, right? So it's not as, if you fabricate fake losses but do not have basis to take them, you should not be taking them. But what you should not be fabricating fake losses. But pass-throughs will give you this form, the K1, and this has what you need to report on your individual 1040. Okay, over here in that funnel, like it would also be here on line 8, some version of it. Like it would have 2,000, right? So now this guy, because we still have our Schedule C, is 17,000. Okay. So that's what's passed through, right? Like it doesn't pay its own tax at the entity level. You as the individual will pay the tax. Now the company, the pass-through that you have, should fund those taxes through a distribution, is what it's called. So that's kind of how pass-throughs work in a nutshell.
Okay, so I have a follow-up question. Let's say if someone is getting W-2 and also start a business. And of course, the business at the beginning, like maybe first year or first 2 years, doesn't generate revenue, but it has a lot of expenses. So are you suggesting to not deduct that from, and let's say it's a pass-through, are you suggesting to not deduct it from the W-2 income?
No, not at all, because they are. So there is a rule that, you know, that you have to be an operating business to take deductions. Okay. If not, you have to do what's called capitalize them. But if you happen to have opened your store, right? Let's just say it's a store.
Right.
And you know, you do have sales, but your losses far outweigh your sales, then that's fine. That's a legit business, right? You'll have the records to back that up. You'll be able to take the loss if it's not a passive activity, and if you also have basis in it. Okay, there's these questions on the LLC here, right? There's the capital. That means you have basis. If this is positive, like here, let's say $10,000, and then you had $2,000 in income, that's basis, right? You have $12,000 in basis. So next year, this number here would be 12,000, but now we're going to lose 15,000. But to lose that 15, we also had to put in 3. Right? That gives us the ability to deduct those 15,000. Okay? So it's not, it's what I'm saying is, do not create fake farms, do not create fake businesses without a profit motive, right? Because then the fact is, if you say, I have a trading cards business and you have losses, 5 years in a row, you will get audited and you will be in trouble. If you have a business that is heavy investment up front, that's operating, that is, you have the intent is for it to make a profit, then by all means, right? Like you're not doing anything shady to try to skirt the law.
Thank you.
Okay. There is a question. As a W-2 employee, can I deduct kids' school fees? So there is a schedule that here, schedule 8812, that you put in who you paid, how much you paid. You'll need their EIN and all those things, and you will get a credit here on line 19. It won't be dollar for dollar. So if if your school tuition is $10,000, you're not going to get a 10,000 here. You'll probably get like a 2,000, something like that. So yes, you can do something. It's not dollar for dollar, but it's there. Anything else? Any other questions?
You said something about like if someone sold their houses, it's going to be complicated then.
So yes, so
Okay.
So the tax code is designed to incentivize certain behaviors, right? One of those is the government can provide housing for all of us. So let's try to incentivize people to buy them. And we also want to incentivize people to move. And so if we do not tax those sales, they will probably move, and it keeps the economy going. So your home, your personal residence, there's an exemption, right? If you are single, you can exclude up to $250,000 of the gain, but you have to have lived there 2 of the last 5 years. If you are married, you can exclude up to $500,000 of the gain, and you have to have lived there 2 of the last 5 years, same rules. So, if you're somebody that wants to move every 2 years and you happen to make $100,000 profit on every house every time you move, you don't pay tax on that. That's the code. If you make, and when I say make, I mean, let's just say it costs you $500,000 and you sell it for $1.1 million, $500,000 are excluded, and then you will pay tax on that $100,000 at capital gains. But the first 500,000 are excluded. So I mean, that's one of the prettiest things in the tax code, along with the 401k.
Hey, just a general question. If you have a business and then you buy a car that you intend to use it with that business or in that business, can you deduct that from the taxes against that business?
It depends. It depends. Yes, there is a deduction. Now it's a matter of how aggressive you or your tax professional wants to be. Okay, because unless you buy a car, and let's just say you are a Amazon delivery truck service, you will buy trucks for that. You will probably not use those trucks on the weekend to go out to dinner. Right. No. Now, if you tell me you're in real estate and you want to go buy a, I don't know, a Yukon, right? Over 6,000 pounds, so eligible for 179, but there is a component of it that is business use, and another component that is not business use, that it's personal use. Because if somebody tells me I work 100% of the time, that is not true. You know, I would say Jamie does, but that's not true.
It's not true.
So, you know, there's a, yes, you can deduct something, right? It's just a question of how much risk can you tolerate?
So more or less, you can choose to deduct some amount of that.
The choose is a strong word, right? I mean, ideally you have some breakdown of business use versus personal, like 70-30, right? Like if it costs you $50,000, right? 30% of that you don't deduct, and 50% of that you do. But whatever you use, you need to have backup for. You can't just say, oh, today I feel like deducting X. I mean, no, you'll get in trouble.
Hey, Victor, with COVID, there is people have worked remotely and it has become the norm now. Is there any way that would affect W-2 recipient, either in a negative or in a positive way, or would a person need to have an LLC to benefit from it?
So this is what's a little weird, right? Ideally, right, your employer was reimbursing you for some of those charges. You know, some internet allowance, some home office setup, stuff like that. Because back in the day, before the tax code change, there was a place where you could deduct what were called unreimbursed employee expenses. There is no place for that anymore. And your W-2 income does not qualify you for a Schedule C. Your employer would need to pay you, okay, here's $5,000 on your schedule on a 1099, go deduct whatever you want on a Schedule C. Okay, fine. I wouldn't do it, but you know, that's a way. But unfortunately, as a W-2, you're pretty much tied down to the forms.
Victor, we really appreciate you taking time to educate us on this. And, you know, just again, thank you. And everyone, if you have any questions, feel free to reach out. Jackie will have the recording that she will send out as well. So thanks everyone for your time, and we will see you in 2 months. We are planning, if all goes well, to have a recruiter come and talk to the group so you can have all your recruiting questions answered. Thanks again, everyone, and have a great night.
Thank you very much. Thank you, everybody. Thank you, Victor.